Started. Thank you everyone for joining us today. My name is Helen Wiley and I'm the Director of Programs at Insurance for Good. I'm so excited to be moderating today's Research for Practice webinar. This series, for those that haven't joined us before, is designed to help connect leading research to policy and practice. And I'm very happy that today Daniel Schwarcz is joining us. Before I introduce him, a few housekeeping notes. Today's webinar is being recorded and will be uploaded to our YouTube channel and sent out to all registrants following the webinar. So if anyone has to hop off early, we will be sending it to you via email. We're going to leave plenty of time at the end to answer questions. So please drop questions as they occur to you throughout the presentation into the Q&A, and we'll get to as many as we can following Dan's presentation. We'll also be sharing some resources and Dan's work in the chat, as well as sending those out after the webinar. So please engage with those. And with that, I'm excited to introduce Professor Daniel Schwarcz. He is the Fredrikson and Byron Professor of Law and a distinguished university teaching professor at the University of Minnesota Law School. And his scholarship focuses on insurance law, financial regulation, consumer protection, and the growing role of AI in legal practice and legal education. So he's going to share his work on 3 really wonderful papers that have come out in the last year for about 25 minutes or so, and then we'll use the rest of the time for questions. With that, I'm going to stop sharing my screen and turn it over to Dan.
Great, thanks so much. And we're going to see if I can now share my screen without too much trouble. All right, let's see here. All right, so hopefully you can see my screen now. So it's a real pleasure to be here, and I really appreciate the opportunity to talk about some of my work. So what I'm going to talk about for the next 25 minutes or so are 3 different strategies that I've written about, and they're not meant to be the only strategies out there, but 3 strategies that all have the same goal. And that goal really is, I think, consistent with the name of Insurance for Good. They're meant to suggest ways that we can have legal and regulatory reforms that better leverage insurance mechanisms to promote adaptation and resilience to climate change. And so first, I'm going to be talking about mechanisms for replacing what I consider to be problematic rate regulation by states with mechanisms that actually more directly achieve regulatory goals while preserving risk signaling in the context of insurance markets. Second, I'm going to be talking about regulatory reforms that can potentially promote what's called group insurance in the context of property insurance, and why those might be promising reforms to promote climate adaptation and resilience. And third, I'm talking about regulatory reforms that can recognize certain types of parametric contracts as clearly insurance contracts that can again drive climate adaptation and resilience. So for each of these topics, I'm going to give you sort of the basics, and then the real goal is to get you to hopefully look at some of the underlying research papers, which of course go into a lot more detail on the underlying ideas. So let's first start at the first strategy that I've written about and I believe is really important for using insurance and harnessing insurance to promote climate adaptation and resilience. And the basic idea of this proposal, the summary of which is here, and I have the link to the actual paper stated below, is that there are real problems with the way that states regulate insurance rates in ways that actually really hamper the ability of the insurance industry to promote climate adaptation and resilience, and that smarter regulation can actually achieve some of the goals that we have for rate regulation without creating the underlying problems of hampering climate adaptation and resilience. So let's start off with some background here. Pretty much every state has laws that date back to the 1950s and 60s that prohibit insurance rates that are excessive, inadequate, or unfairly discriminatory, at least when it comes to property insurance. And the basic sort of rationale for these rules was that back in the 1950s and 1960s, insurers really did collude in pretty anti-competitive ways to fix rates. So they published advisory rates, and all of this meant that there was really not much competition among insurers. And there was a belief that this was sort of inherent to the notion of insurance, that insurers had to set advisory rates and share information in a way that was anti-competitive, because otherwise you would have what was known as ruinous competition, where insurers would become insolvent. Now, the problem from the perspective of climate with respect to this rate regulation is that it's pretty clear that this rate regulation is problematic in terms of allowing insurance to communicate to policyholders the risks that they are taking on when they purchase certain property, or when they maintain property, or when they fail to upgrade property. In an ideal world, a central value from an insurance perspective of insurance rates that are actuarially fair is they communicate something to you. They communicate the risks associated with your property, and they communicate the extent to which you are mitigating those rates. And so to the extent you have regulation that undermines the communicative value of premiums, of rates, that can result in people buying property too much in hazard-prone areas. It can result in people getting poor signals about the extent to which their efforts to mitigate risk are effective. And indeed, there's some really good empirical evidence that I've cited on these slides, and there's a lot more out there, showing that this is a real phenomenon, that when we have rate regulation, what happens is people just get much less good information about the risks they're taking on when they're purchasing property, when they're maintaining property, when they're mitigating risks. And also, we get sort of a perverse result where people who are purchasing less risky properties or maintaining less risky properties from a climate perspective end up cross-subsidizing those who are not, who are more risky. This is just a problem if we want to have climate adaptation and resilience, because we want people to be building in areas that are safer, and we want people to be adopting measures that reduce risk. Now, at the same time, it's important to recognize that rate regulation does have a rationale, but the problem is that the underlying rationale that sort of originally was behind rate regulation doesn't apply. And the reason for that is it's actually no longer the case that insurers collude with respect to setting rates. In fact, that type of collusion was effectively prohibited in the 1980s and the 1990s. And nowadays, while insurers do share sort of information about losses, that's generally recognized as pretty pro-competitive. So the original idea of regulating insurers like they're monopolies, which is how we regulate, say, natural monopolies in energy production, doesn't really apply. But that doesn't mean that there aren't market problems in insurance markets that may justify some type of intervention. And the real problem that I think, if you look at insurance markets and you look at the research that exists with respect to rates in particular, is that consumers oftentimes are not actually shopping for coverage. Once people actually purchase coverage, they tend to stick with it. They know very little about what types of different insurance are out there. When they shop for coverage, they only go to one insurer and maybe look for it, and they only do it every once in a while when there's a sudden shock. And that's part of why there's so much advertising about insurance on television, because it turns out that if you can get someone to shop and consider you first, right, they're probably going to buy from you. And so we get all this energy that's focused on trying to get people to like do one comparison shopping tour once in a while. And what that means is that at the end of the day, we don't have as much rate regulation as we might like. And sometimes insurers do make profits that maybe are more than we might think are appropriate. So the question is, can we address this regulatory problem in a way that doesn't create the market distortions that we were talking about earlier in terms of risk signaling? Can we address the actual regulatory problem in a better fashion? Because if we don't, not only are we not going to get prices that are competitive, but that in and of itself will undermine the extent to which insurance is effectively communicating to consumers what their risks are. And it also means, by the way, that people may not even know exactly what they're insured for, right? And so here's the main suggestion that I talk about in my paper and that I want to spend a little bit of time on discussing. If at the end of the day, the real driver of market problems with respect to rates is the problem of consumer shopping, but not a problem of the number of insurers. There are a lot of insurers that are out there, and not a problem of collusion. Then what we should be thinking about are building mechanisms in the market that can address that problem directly. And it turns out we have pretty good ways to do that and pretty well understood ways of doing that, even though most states have not implemented that in the context of property insurance. So the first thing that's really necessary is to set a clear regulatory floor for what a homeowner's insurance policy covers. And a lot of people sort of think that a homeowner's policy is standard, but it turns out it's not. It turns out that even among insurers that are offering, basic homeowners insurance, each insurer has a different policy form that can vary a lot in its particulars. And what that means is that it's very hard to comparison shop because you don't actually know what you're getting. And you may be getting something different when you purchase a product from one provider as opposed to another. Now, realistically, there's no way that consumers are going to know about this. There's no way that they're going to comparison shop. And so it makes it very hard for consumers to actually make good decisions about which insurer they should go to if they have to compare along many, many dimensions. It turns out we have historically had a set of rules that set a policy floor and said, oh, if you're going to sell homeowners insurance, this is how good it has to be. In fact, about 100 years ago, we had a standard fire insurance policy that set a mandatory floor in many states, and insurers were statutorily obligated to offer that coverage or something better. But what's happened is that as homeowners insurance has evolved to cover many more perils besides fire insurance, we've lost that mandated statutory floor. Instead, every state has a variety of different mandates, but they're all very particular, and none of them are sort of comprehensive and say, hey, this is the mandatory floor that you have to offer if you're offering homeowners insurance. If we had a mandatory floor, that would make it much easier to comparison shop because you would know, hey, look, the product I'm getting from insurance A is identical to the product I'm getting from insurance B, or at least just as good with respect to the essentials. Okay. Now, the second thing I think we need to do here, and this is the second bullet point, is to build insurance exchanges. We actually have insurance exchanges in the health insurance sphere, right? And a lot of you may be familiar with healthcare.gov or other insurance exchanges that are state specific. And the goal of an insurance exchange is to make it incredibly easy to comparison shop and to compare premiums. If I want to buy health insurance on the individual market in Minnesota, I just go to one place, MinSure. I type in some information, and then I get direct quotes from all the insurers in the marketplace, and I can just press one button and actually purchase it directly from the exchange. And I know that all of those comparisons are offered on an apples to apples basis. Now, this is an incredibly powerful way to facilitate consumer shopping because it just makes it much easier, much less daunting, and indeed, there's pretty good evidence that this does reduce the barriers to consumer shopping in the health insurance space. Now, it's true that we haven't seen rates go down as much in health insurance as we might have liked. But one of the reasons for that is in health insurance, we actually don't have nearly as many competitors as we do in property insurance. And so if we actually built upon some of our experience in the health insurance domain and built insurance exchanges that would allow people to go to one place to get apples to apples quotes from insurers that were trustworthy, that didn't require them to input information multiple times, and that allowed those who wanted to skip the process of working through an insurance agent, we would actually address a lot of the concerns with respect to lack of competition on rates, and we'd be able to effectively get rid of rate review that really compromises the signal that rates send to consumers. So we would get real competition in insurance markets. We'd address the underlying problem that rate regulation is meant to resolve, but we do so in a way that would maintain and actually sharpen the extent to which rates effectively reflected people's risk. That would, again, I think, and I think the evidence is reasonably clear on this, give people better insight into the risks they face, better insight into the extent to which measures they take can mitigate those risks. So I think that the link to that article is in the chat, and I'm happy, of course, to talk more about it. But now I want to go on to the second idea that I want to talk about. So the basic idea here is that I think we need more innovation in homeowners insurance markets regarding the structures that are available. And I think actually there's some very good reasons for believing that if we were able to facilitate what we're going to call a group insurance markets, that could actually really do a lot to promote climate adaptation and resilience. And again, the underlying article is available online. There's a link to it here, and we'll be putting a link up to it in the chat. So let's talk about the basics here. I made it sound like if you just have an unregulated insurance market, insurance rates are going to communicate great information to people about their risks. And they'll communicate better information. But the problem is that they're not going to communicate perfect information. There's still going to be a weak signal in terms of the extent to which insurance prices are going to reflect risk. And that's for several reasons. But one of the real reasons is before I actually get into that, not only will the price not fully reflect risk of climate, it will reflect other risks other than climate, but it also won't necessarily reward risk mitigation. And this is something I think many people have experienced in their own personal lives, where they make improvements on their property that are meant to address perils associated with climate, like reducing wildfire risks, and they don't see premium benefits. And so we have empirical studies on both the fact that insurance rates right now don't really communicate long-term climate risk, and the fact that oftentimes without legal interventions, effective risk mitigations are not rewarded in terms of insurance premiums. And we've seen that both in California as well as in Alabama and many other states, where it's taken legal interventions in order to get that recognition. And in many cases, those legal interventions don't actually work as well as we might hope, because it's hard to compel market actors to act when they are not otherwise inclined to do so. So the question is, how can we get prices to drive adaptation and resilience when that doesn't happen as well as we might like, even if we take away rate regulation? Well, in order to understand that, we have to diagnose why it's the case that insurance rates don't reflect long-term climate risk as much as we might like. And there are several real reasons for that. So the first reason that I want to talk about is that in many contexts, effective risk mitigation really requires collective action. It requires not just that an individual do something to their home, but that the community within which they live does something. And this is clearest, I think, with respect to perils like flood and with respect to wildfire. If you want to actually limit your risk of wildfire, there are certain things you can do to your home, but the most effective measures are things that your broader community will do. And the problem is individual insurers don't have any really good incentive to promote that. Because if they promote that, many of the benefits of that actually are experienced by their competitors. So it's a classic collective action problem. Moreover, another really fundamental problem is the risk horizon problem. Many of the risks associated with climate change are, of course, long-term. And yet, the insurance policy is an annual policy, right? And so the insurance policy is not going to reflect long-term risks. It's only going to reflect the risks in a given year. Not only that, but it turns out that when you have certain types of measures that you take to limit your risk, in order for the insurer to really reward them, they have to invest a lot in monitoring your compliance with them. So if, for instance, you take measures to limit the shrubbery around your house and to maintain defensible space, it's not enough for an insurer to say, great, we're going to price on that basis. They have to ensure that you continue to maintain that defensible space, and that's difficult. Finally, we just have real consumer capacity problems, right? Not every consumer has the budget to invest in large, expensive projects that are going to mitigate risk, even if they're sort of net positive from an economic perspective. They just may not have the funds. So there are real fundamental reasons why even in unregulated markets, risk signaling and risk pricing are not going to fully reflect real risks associated with climate, even if we solve some of the regulatory problems that I talked about in the first unit of this talk. So here's the idea that I want to propose. What I want to propose is that we think about and experiment with new models for delivering property insurance and homeowners insurance. And in particular, if we have group insurance, I think there are reasons to think that that will solve certain problems. Now, let me first start off about what is group insurance. And for most people, the real sort of familiarity they have with it is in the context of health insurance. Many people have health insurance through their employer. And the way that works is that the employer negotiates a contract with an insurer, and then it makes that contract, that coverage, available to its employees, and employees can opt to get that coverage or not. They don't have to secure it. They can go buy health insurance in the individual market. But there oftentimes are good reasons why people choose to get insurance through their employer. Now, some of those reasons are tax reasons, but some of them are sort of more fundamental economic reasons, right? Like there's certain economies with having your employer negotiate this on your behalf, and there are certain ways in which your employer can better represent your interests, harness sort of the collective purchasing power of its employees. Okay, and in fact, there are already not only group insurance models in health insurance and in life insurance, but there actually are certain group insurance markets in the context of property insurance. So California actually has certain group insurance policies, or things that resemble group insurance policies, with JPAs, joint property associations, that I can talk about. And in some states, and I think Utah is the best example here, insurance regulators have allowed communities like homeowners associations to form captives that then offer coverage on a group basis to consumers. So the point I want to make here is that even though we're not very familiar with the idea of group property insurance in the context of group insurance in the context of property insurance, it's very familiar in the context of health and life insurance, and we've seen in recent years versions of this that are emerging in the property insurance space. Now, before I talk about how we can really use law and regulation to facilitate this, and by the way, I see that you can see now the problems I have with my motion-activated lighting, so I just have to gesticulate widely to make sure my lights stay on. But now that my lights are on, let's talk about why I think this is a really promising route to go on if we want to address some of the problems that I talked about in my last slide with respect to long-term risk horizons, collective action, and consumer support, and so forth. And let's go through each of them. First, collective action. If you have an insurer that actually ensures a critical mass of a community. It doesn't have to be everyone, because remember, even if you have a group insurer, people don't have to purchase insurance through that mechanism. But if you have a local community who negotiates with a specific insurer and says, hey, we're going to negotiate this group policy, and then anyone in the community can opt into it, and maybe there'll be some variation in rates that are negotiated by the community and the insurer, so that rates are individualized within the community, and people who have larger houses or who live closer to certain perils pay more, but still it's all through this group mechanism. You can, to some extent, resolve the collective action problem, because now the insurer effectively bears a significant proportion of the risk within a community. And now if they proactively work with that community to reduce risk, those benefits are principally go to the insurer, because they're insuring that critical mass. And so you are able to address that collective action problem where an insurer that's insuring that community as a whole, or many homeowners within it, will affirmatively want to work with that community to mitigate risk. And by the way, some of the examples that I talked about in my last slide, both with respect to JPAs and captives, one of the real sort of things we've seen anecdotally is that there's evidence that these insurance mechanisms are working more proactively with the community to reduce risk, precisely because they bear a large proportion of that risk. But it's not only that. I actually think that group insurance can solve the risk horizon problem as well. Now, there are many proposals out there to, say, have long term property insurance policies, but the problem with that is that the industry doesn't want that. And I think it's very hard to force insurers to offer 3-year, 5-year, 10-year insurance policies because, of course, that reduces their optionality. So while I think that's an important sort of road to go down, I think a more promising road for getting insurers and policyholders to have more long-term risk horizons is to do so by building long-term relationships that are long-term simply by the fact that there's been investment by both sides and the buildup of relationship and goodwill. And I think that can really work in a group insurance setting. When you have a group insurer that's insuring many folks within a locality, they're investing in marketing in that community. They are making certain investments that then pay off in the long term, and so they'll have an incentive to stay. And if they want to drop individual members from that community, they can do so. So you can have a group insurance arrangement that still allows the insurer to say, yes, but we won't insure anyone in your community who, for instance, doesn't follow this risk mitigation advice or who has more than 5 claims in the last few years. And so you can naturally build a more long-term orientation without necessarily forcing long-term commitments by either the community or by the insurer. And there's actually a very large literature in the contract law literature about long-term contracting that is oftentimes much more effective by the building up of relationships as opposed to by contractually mandating a long term. Moreover, there are good reasons for thinking that local communities can actually monitor compliance with risk mitigation much more effectively than can insurers. And that's because local communities are, of course, in the community. And they're already looking at property level characteristics for tax reasons, for community power reasons, for policing reasons. So they're already looking at this information, gathering this information. And so they're much more natural repositories of efforts to ensure that people are complying with risk mitigation measures than are insurers, who it takes a lot of money and effort to make sure that every individual homeowner, for instance, is maintaining a defensible space. Finally, in terms of capacity, localities, large communities, they just have not only more resources, but more capacity to get expertise to facilitate this process. So they can get things like like bonds, local bonds that they can use to actually invest in long-term projects if they get an assurance or at least a prediction from an insurer that's going to reduce risks. And so they have fewer capacity constraints. Now, I don't want to suggest this is a silver bullet. There are, of course, many reasons why insurers might not be interested in offering group insurance, and I have some of these, at the bottom of this slide over here. Probably the most important are the fact that this is going to create correlated risks, and so some insurers are going to be wary of that. But recognize that an insurer might choose to offer some group policies in communities in different parts of a state or different parts of the country, and also to diversify in individual markets. And they also might be able to use parametric contracts, reinsurance policies to limit this risk. There are other issues as well. But the point here is that there's at least good reason to think that this is a promising way to experiment. Well, if it's a promising way to experiment, why haven't insurers done this? Well, the answer is, it turns out law and regulation currently, for the most part, don't allow insurers to do this. Most states have rules called fictitious group laws that actually prohibit or severely limit the extent to which property insurers can offer group insurance. And these laws, if you go back to the history, were actually advocated by insurance agents who were jealously guarding their commissions and who didn't like the idea of group insurance because it ate into their commissions. Well, that's not really a good public policy reason for prohibiting group insurance. Even states that don't have this, they have laws prohibiting unfair discrimination that I referenced earlier. And those laws are often interpreted by states to severely limit the extent to which an insurer can offer a group policy to a locality, with the idea being that there's a concern that if an insurer offered a group insurance policy to one locality, you'd have an individual within that locality who theoretically posed the same risk as an individual who is not within that locality, but who is charged a different rate. So that's another barrier. We also just have sort of other rate review mechanisms like territorial rate review that might limit this. this. And so my pitch here, and again, you can read more, and I hope you do read more in the paper that's linked in the chat, is we should, at the very least, create regulatory sandboxes where we allow insurers to experiment with this, where we say, you know what, if you want to offer a group policy to a community, whether it's a town, whether it's a village, whether it's a homeowners association, and you want to work with that community, we're going to allow you to do that and not say that you're not violating the law, with the hope that that's going to produce many of the benefits that we talked about. Now, there's sort of more aggressive techniques that could be used. Obviously, you might use tax incentives, so that's costly, and I don't think you need to. You might have regulators trying to affirmatively generate interest in this market, because I do think that established players like State Farm and Farmers are going to be less interested in disrupting the market. So you might need to bring in insurers who are not big players in conventional homeowners insurance markets, but who want to explore these alternative mechanisms. You might need to use captives or other arrangements. But at the end of the day, this really is an idea that, hey, there are reasons to think that a market here might at least solve some of the problems that we have traditionally seen about why insurance rates don't reflect risk and why insurance rates don't always actually reward long-term risk mitigation, while at the same time allowing the market to do that in a way that doesn't require potentially unrealistic expenditures by public entities or unrealistic levels of sophistication and market development by public entities. Okay, let me now turn to my third idea that I've written about. And again, you can learn much more about this in the underlying paper that's publicly available and that's coming out in a few months. And I should mention this is actually jointly authored work with Jerry Skis. And this is about what's called parametric contracts and the extent to which parametric contracts can also be leveraged to promote climate adaptation and resilience. So let's just start off with some basics. What is parametric insurance? The basic idea of parametric insurance is that this is a policy that pays out not when an individual suffers a loss, but when some objective threshold is met. So that objective threshold might be something like wind speeds of a certain amount in a certain region, and if that occurs, then the insurer pays out. And the real reason why parametric contracts can be valuable in providing coverage is that they pay out incredibly quickly because there's no need to actually go and investigate any individual person's loss. You can simply look at the objective trigger. There are many fewer coverage disputes as well for that very reason. The triggers are designed to be objectively verifiable and sort of determined by some third-party entity that is neither the insurer nor the policyholder. And at the end of the day, this is also much easier for parametric contract providers to model from a risk management perspective because there are a lot fewer variables to model. And so this can significantly increase the capacity to insure against certain catastrophic risks. The problem is a significant one, and the problem is basis risk. Because just because some objective threshold is met, say wind speeds of 100 miles per hour in a certain region, doesn't necessarily mean that someone living in that region or that some locality in that region suffers losses. It might be that there's a large, significant wind speed and just doesn't cover any result in any damages. And in that event, people actually receive a payout when they didn't suffer any damages. The reverse form of basis risk here is that it may be that there are significant damages even though the trigger in a parametric contract is not met. And so this is basis risk, and it's really the fundamental difficulty with parametric contracts. Now, even though parametric contracts have all of these benefits, and these benefits in terms of making insurance more broadly available, particularly when more conventional insurance markets are not willing to insure risks, there are some real problems that are associated with law and regulation in this space. And the basic fundamental problem that limits the extent to which parametric contracts are able to really offer protection is that basis risk creates a real regulatory classification problem. And that's because under state insurance law and independently under federal financial regulatory law, the fact that we have the prospect for windfalls with respect to parametric contracts means that it's unclear whether parametric contracts are actually insurance policies or certain types of derivatives known as swaps. And actually, if you really look at some of the definitions both under state insurance law as well as under federal law, it's not only is it unclear, but frankly, the arguments are somewhat more convincing that traditional parametric contracts are swaps and not insurance. And the reason for that is that traditionally, under state insurance law, an insurance policy has to follow this basic principle of indemnity. It has to make sure that an insured is no better off than they would have been had the loss not occurred in the first place, the underlying loss. And the fundamental problem is there's no way that a parametric contract can promise that. No matter what, if you have a parametric contract that is using an objective trigger, there's basis risk, and one side of that basis risk is the fact that there is some theoretical possibility for a windfall. That, from a statutory perspective and also from a federal regulatory perspective, creates real problems. And it creates real problems because it means that in order to sell parametric contracts, there's all of this cost associated with this regulatory classification problem. And when parametric contracts are actually classified as derivatives, as swaps under federal law, then actually that not only increases the cost of getting it, it also limits the practical ability of many, not only individuals, but frankly, small localities, like we were talking about before, small companies, to actually acquire this. Because it's very hard to go into swaps markets and buy swaps if you're not a sophisticated actor. And in some cases, it's practically impossible. So we have these regulatory mechanisms that limit the availability of parametric contracts. And that is really problematic if we think that this is one promising tool for addressing some of the risks associated with climate. Well, what we propose in this paper are two ways of structuring parametric contracts that we argue kills two birds with one stone. They simultaneously make clear that certain types of parametric contracts are actually insurance and not securities, and so they can be sold as insurance and regulated as insurance. And they do so in a way that actually promotes affirmatively climate adaptation and resilience. So let me run through these two, but again, as before, the real, a lot of the details I'm going to have to glide over, and I'd encourage folks to look at the underlying paper, which is available in the chat. So the first type of structure we talk about in this context are what are called forecast-based contracts. And the basic idea of a forecast-based parametric contract is that the trigger in the parametric contract is not whether some actual weather event occurs, say 85 miles per hour wind speed in a certain region, but instead a specific forecast of that risk in the future. So, for instance, the trigger would be met if there were a forecast of a Category 3 hurricane hitting certain parts of the Florida coast by certain reputable forecasters. And if that occurred, that itself would be the trigger that would deliver funds. Now, those funds would then actually go to allowing that locality to prepare, to move people, to board up buildings, to give out grants to board up buildings, to in certain cases, maybe build temporary shelters that people can be protected from. It turns out that there are a tremendous number of things that can be done when you have a reliable forecast of a severe weather event that is coming that can substantially reduce risk. But the problem is that many localities don't have access to those funds, and they don't want to spend that money because the hurricane might miss. If you have a forecast-based parametric contract, the beauty of this is that there is a need to spend these funds from a sort of prudence perspective, whether or not the hurricane actually hits. Once you have a reliable indicator, a reliable forecast of a severe weather event, it is prudent to spend funds to mitigate risk, irrespective of what happens next. And what that means is there's no risk of windfall. And so what that means is that if you have a parametric contract that is based on a forecast of an extreme weather event, then what you can say is this is clearly insurance. We should allow localities and other institutions and small businesses to buy this type of insurance as insurance. And not only that, but this insurance will actually be used to mitigate risks by funneling funds into measures to deal with forecasted weather events. Now that's somewhat narrow. Our second idea is actually, I think, much broader. And the idea here is what we call restricted use parametric contracts. So with traditional parametric contracts, there's a lot of attention spent on what the trigger is in order to reduce basis risk. And that's great, and that's important. But once the funds are paid out, they can be used in any way by the recipient. Now, that is helpful in terms of reducing some of the bureaucracy and costs associated with parametric contracts. But the problem, as we talked about earlier, is that fundamentally leads to the problem of indemnity and the problem of windfalls. So what we propose with restricted use parametric contracts is that the parametric contract require the recipient to use funds either to offset any losses that are caused by an associated event or to invest those funds in risk mitigation for the future. And we talk about sort of certain soft, relatively non-intrusive mechanisms for ensuring compliance with that. But what we think is that this also avoids the legal and regulatory problems associated with windfalls. And that's because there is a pretty well-established legal exception from the indemnity principle when people use insurance proceeds not to offset risks, but to mitigate risks associated with the underlying peril. And perhaps the best example here is what's known as law and ordinance coverage. Every homeowner's policy has additional coverage that allows you to build your home up to new law and ordinance, new codes, even though technically that gives you a home, a dwelling that is more valuable than your old home. Even though that's true, no one has ever argued that that violates the principle of indemnity. And we think the reason for that is because it's pretty consistent with insurance ideas that you might use insurance funds to harden your home and reduce the chances that you're going to have a similar type of risk. And so similarly, we think that restricted use parametric contracts would very clearly be insurance products and not derivatives products, could be sold as insurance products, and not only that, but they would harness state law to actually allow parametric contracts not only to protect us against risks associated with climate, but to also incentivize us to use and facilitate our ability to use those funds to reduce our exposure in the future by saying, look, if you get these funds and they're larger than any loss that you've experienced, you've got to invest them in hardening your property in the future. Okay, so that's the basic idea. I'll just say one word on shortfalls. This is also a concern, and I don't think anyone thinks that parametric contracts are going to replace or should replace traditional insurance policies. But what we think is that to the extent there's a concern with shortfalls, one, those can be managed through traditional insurance mechanisms. And two, to the extent there's a regulatory problem there, it's a pretty conventional regulatory problem that insurance regulators have familiar tools with dealing with, right? You should know that there's basis risk when you're buying parametric contracts. Disclosures should be made. There might even be some need for fiduciary obligations when it comes to ordinary consumers. And people should only use this as one part, and entities should only use this as one part of their risk protection scheme. Now, one final point I want to make here is look how some of these ideas fit together, right? Because all of the ideas, they're out there, but if you think about them, right, if we have collective coverage, where we mentioned that one of the big risks is that there's aggregation risk, if we facilitate the ability of localities to buy parametric insurance, that can help them deal with some of that basis risk. Similarly, if we are able to replace traditional rate regulation with a market-oriented mechanism, we might be able to have exchanges that facilitate the ability not only of individuals to purchase homeowners insurance, but facilitate the ability of localities to purchase group insurance. And actually in the health insurance space, there are insurance exchanges that facilitate the purchase not just by individuals, but also by small businesses. So some of these ideas fit together, and I hope therefore that they offer some new ideas for helping harness law and regulation to really allow insurance to do what we all want it to do, which is to do social good. to help us adapt to a world where climate change is going to prove increasingly threatening to our way of life. So, with that, I really look forward to the conversation.
Thanks so much, Dan. Really rich content and really loved how you started bringing it together there at the end across the papers. We have a lot of questions and we're not going to be able to get to all of them. And so I really want to jump into some of the group insurance discussion that folks are asking about in the chat. And so I think when you think about what types of communities are best positioned to take on these different types of group insurance models, obviously there's a variety of needs that they could serve. But you know, how do you think about these issues of the realistic paths for these types of models benefiting more wealthy communities versus lower income communities, given some of the resourcing needed to create these types of policies? And I think along with that, some of the questions in the chat were about, how do we deal with this issue of concentrated risk? And so as well as we're thinking about where these types of policies are best placed, how do we deal with this, that in a really highly prone wildfire area, you'd have such concentrated risk? And so are these types of policies better positioned for folks or areas that are less disaster prone? So I think thinking about those income issues as well as concentrated risk approaches, where are your thoughts about that right now?
So, both really good questions. So, let me try to tackle them each. Let's just start with the low income versus high income issue. This is a really big concern. And I do think that it's entirely possible that group insurance will prove to be a more attractive model for certain high income communities. What I don't necessarily think follows is that that will harm low income communities, right? Because if we are working towards a model where we want actuarially fair rates, just because a high income community or a moderate income community is able to negotiate a group rate with an insurer, that doesn't mean that folks who don't live in that community are not going to have access to traditional insurance via individual markets. And so we shouldn't necessarily expect that this is going to hurt low income communities unless we're already trying to help low income communities through rate regulation. And there, my view, and I know that this is a view that not everyone shares, is that we should help low income communities, but we shouldn't do so by distorting insurance rates. And so the way to help low income communities, and this is actually something I talk about in my Obamacare for homeowners insurance piece, and it's not my idea, this is an idea that's been around for a long time, is that we actually should just provide direct subsidies for low income communities to help them purchase insurance and that are actually tied to their realistic need. That's actually what we do with Obamacare, and it's a much better way of helping subsidize low income communities than sort of having hidden subsidies through rate regulation. Because actually, if you have hidden subsidies through rate regulation, oftentimes many of the subsidies don't end up going to folks in low income communities, they go to folks in high income communities. And if we look, for instance, at something like the wildfires that hit the Palisades, for instance, a lot of those folks are very high income folks who were getting massive subsidies from rate regulation because of the fact that rate regulation basically created cross subsidies from low risk to high risk. So in my mind, the right way to tackle the problems associated with the fact that insurance isn't always affordable to low-income communities, and to recognize, for instance, that certain folks living in low-income communities are living in places that are particularly at risk from climate for no reason of their own, but for reasons associated with, say, redlining, historic redlining. We need to address those issues head on. But in my view, the way to address those issues is not through rate regulation. So sort of a two-pronged answer to that, but the answer is group regulation, group insurance policies may indeed be more attractive to some higher income communities than lower income communities, but that shouldn't be problematic except to the extent you have a set of views that I reject. Okay, that's the answer to the first question. The answer to the second question about aggregation risk is a really important one. And it is very clear that if you're an insurer and you're offering group insurance, you are going to face aggregation risk, which is why I would assume that any insurer getting into this business would need to be sort of well capitalized, would have to have access to reinsurance markets, and would want to be very strategic about how they did this, right? So they wouldn't offer group insurance to, all communities in Southern California, right? They might offer group insurance to one small community in California, one small community in Florida, one small community in whatever. So they would diversify their risk, and then they would use very traditional tools to try to offset this, right? So they might actually purchase parametric contracts that would allow them to reduce this risk. They might buy traditional reinsurance. And so I think that aggregation risk is absolutely a risk that insurers would need to manage if they were going to offer group insurance, but I don't think it's an unmanageable risk. I think it's a risk that insurers always have to manage, and I think that it's one that they can manage, particularly if there are offsetting benefits associated with offering group insurance, which I think there would be, right? Actually, that might reduce the basis risk associated with a parametric contract because you know exactly what the trigger should be if you are insuring a locality. Moreover, just think about some of the efficiencies associated with group insurance, and these are very well established in the health insurance sphere. You have a locality that's facilitating your monitoring, that's maybe facilitating other elements of the transaction, whether it's contract design. You've maybe minimized the extent to which you have to pay commissions because you've limited the extent to which you need intermediaries. You have marketing advantages, right? Like you know exactly how to market to the local community. You have potential word of mouth benefits. So I think there are, we don't know how the empirics would work out here because we've never had this before. But to the extent we have things that look like this, they actually work, right? Again, go back to the Utah Homeowners Association example. Go back to the California Joint Association, Joint Property Association. And I think there's no reason a priori to think that this won't work. And I don't think it would also work for everyone. But the idea is we should be allowing experimentation here. We should be allowing the market to tell us whether this might work. And we certainly shouldn't have laws that foreclose this type of innovation, given that, there are offsetting benefits and costs that we might plausibly, intuitively think would come out one way as opposed to another. And so we should allow experimentation.
Thanks, Dan. And combining a few other questions, when we look at these group programs and policy models in practice, are there any specific states, municipalities, HOAs where you're seeing examples of how this model is working in practice right now?
Yeah. So let me talk in a little bit more detail about the Utah and the California examples. So in Utah, the way that this has played out is, and I want to be careful here because I don't have all the details directly at my fingertips. But my understanding is that the state has allowed homeowners associations to create captives that effectively insure the broader homeowners association, and then the captive then purchases reinsurance and other protection against large catastrophic risks. And the primary selling point here is that when you do this, you create much more affirmative aligned incentives between the captive and the community, because the community is the captive in a sense. And so what is the captive doing? It's actually working with the homeowners association to reduce risk. And that's really, at least anecdotally, how it's being sold. And there are anecdotal evidence that this is working. Now, it's not been empirically studied, so it's hard to know how much of this is just sort of talk versus reality. But the very fact that this is workable and that this is being experimented with in Utah, I think is suggestive that there's potential here. I think that there's actually even some more evidence of this in California. So in California, again, I want to be careful about the institutional details because they're complex and they're not directly at my fingertips. But the basic way this is structured, as I understand it, is that there are certain communities who simply can't get insurance, and they've long not been able to get insurance because of how risky they are. And so what they're able to do under California state law, as I understand it, is effectively join together and create what amounts to a joint risk-sharing entity. And that joint risk-sharing entity, and I've spoken with folks who are helping facilitate this, they're really very insistent that this mechanism is much better and much more proactive in helping these communities reduce risk and in rewarding risk mitigation. Now, again, there's not an empirical evidence on this. This hasn't been empirically studied as far as I know. So all I have right now are sort of the statements of people involved. But this is exactly the type of thing that we might expect, right? If you have an insurer that's insuring the broader community, that is invested in it, that has developed reputational capital, that has more of a long-term orientation, that can work with the locality to help monitor compliance, there's every reason economically to think that this can work. And so when you have the economics of it working in a way that at least plausibly might suggest an incentive to mitigate risk, when you see that the ordinary market doesn't do that because most states are not able to get insurers to effectively reward risk mitigation unless they mandate it, and by the way, even when they mandate it, it oftentimes doesn't work very well with a certain exceptions. There's reason to say, well, why don't we let the market experiment with this? Why are we foreclosing this in most states through antiquated laws that really don't have any good public policy justification? And so that's how I think about it. Not that this absolutely will work, not that we empirically know it will work, but that we have good reason to think it works, good anecdotal evidence to think it works. And so given that it would solve its fundamental problem, we should be experimenting with it and seeing if it works.
Thanks, Dan. And final question here, and just want to say first, as we shared in the chat, we unfortunately can't get to all the questions, so please do follow up with us via email if there's any specific questions you dropped or others that come to mind that you would like to get into in more detail with Dan or Insurance for Good. So my final question here as we wrap is, looking across these different policy measures you've spoken about today and what types of regulatory reform could work, what types of entities or sectors do you actually feel like are best placed to help these types of changes to insurance law and regulation move forward? Or are there any good examples of how you've seen this happen in the state?
Yeah, I think that there's a real appetite for experimentation in insurance markets. I think that there are insurance departments that want to facilitate experimentation because there are just real problems in insurance markets. So I think that there are folks within insurance departments that are interested in this. I think state lawmakers are interested in some of this. And I think that one of the keys for me that I keep thinking about when I'm thinking about these is coming up with politically palatable solutions. So I recognize that not everyone is going to think that these are all great ideas. There are certainly downsides to them, but all of them share a certain a structure that I'll just make explicit. They all try to solve what I think most people, at least most people who sort of look at the evidence, think is a real fundamental problem, which is climate adaptation and resilience, right? And in general, this is coded as a left issue, right? But they all do so in ways that try to build upon structured market-based solutions. Because at the end of the day, it's really hard to get governments to come in and say, this is exactly the right way to solve the problem. We all know that, there are problems with just having governments do everything and mandate everything, right? There are certain comparative advantages that markets have. And what I like to think in my sort of more optimistic modes is that that's more of a right-coded sort of way of thinking about things. We want markets to work. We don't trust. And so if we think about putting that together, I think there's at least the possibility of a politically palatable solution here, which is a solution that says, look, let's rely on market-based mechanisms to better align the incentives of insurers and insurance actors and communities. And that will be better for communities, and that will be better for insurance industry players, or at least many of them, and it will be the type of compromise that people from across the political spectrum can plausibly agree to. And so there are certainly other solutions that are out there that could work plausibly, but that might not be politically feasible. And my hope, whether I'm right or not is hard to say, is that by trying to better leverage and harness market-based mechanisms by changing the way that law and regulation work to structure the market better and facilitate the market better, we can actually reach for solutions that are politically palatable.
Thank you so much, Dan. And that definitely echoes many conversations we're having internally at Insurance for Good about how do we create this more robust marketplace that can serve all of the many income groups and actors that need insurance solutions. So thank you so much for joining us today. Everyone, we will be sending out the recording later this week, as well as links to Dan's papers. Please do reach out with any additional questions or ideas you have coming out of today's webinar. We will be announcing soon the next Research for Practice webinar, which will be taking place in September. But in the meantime, we have a different webinar series that we're doing with state agencies in California, and the next webinar in that series will take place on August 14th on flood insurance challenges and solutions. My colleague just dropped that in the chat, and so we hope you all will join us for that as well. It is for folks in California, but really the content works for folks across the country as well. So thank you everyone for joining today, and please do continue to engage with us and Daniel's work.
Thanks so much.